Hey guys, welcome back to another video. And today in this video we're gonna discuss about moving averages. We're gonna discuss about simple moving average and exponential moving average, and we're gonna see how we can use them in order to find support and resistance. And also we're gonna see how you can use moving averages in order to predict the trend reversals, okay, and how you can avoid the false outs in the market. We're gonna also see how exponential moving averages are better than simple moving averages. Okay, so please pay close attention, and I'm gonna summarize everything that I discussed in the end of the video so that you can understand it better. So please stick along and pay close attention while we're going through the video. And also please make sure to subscribe to our channel so that you won't miss any of our upcoming videos, and also press the bell icon so that you will be the first one to know whenever we upload any new content. So without any further ado, let's get started. So the first thing is, in our previous video we discussed what is simple moving average and what is exponential moving average. Let me just redefine that. Simple moving average is just the mean of the previous candles, okay, and in simple moving average each candle gets equal weight. So if we wanted to calculate the close of this candle, what simple moving average would do is take the closes of all the previous candles to the time period we described. Like if we want to take the 9, so it would take the close of all the 9 previous candles, and take the mean, like add them and divide it by 9. Okay, that would give us a data point for this. Okay, but in exponential moving average it gives most importance to the most previous data points, okay, or the candles. So in exponential moving averages, the most recent candle, like if I wanted to calculate for this candle here, then this candle would be the most important, and after that this one, and that importance will go on decreasing as we go behind and behind, okay, as we go backward and backward. So this is the main difference between simple moving average and exponential moving average. And now let me discuss the types of support and resistances that exist in technical analysis. Okay, so the first one is the straight support or resistance. So like straight support or resistance means that whenever we draw a straight support or resistance level, okay, like here you can see that this can act as this zone can act as a good support, okay, or we can say that this zone here is basically a good resistance level, okay, because you can see the price touching and coming down. So let me just change the color of this a little bit, and this one is basically a good resistance level, okay. And now this is basically an example of straight support or resistance. There is another type which is basically the trend line, or the trend, which is basically the trend line support or resistance. So the trend line support or resistance is basically when the market is trending and we find the support or resistance in a trending market, right? So let me just draw this line here, and as you can see here, this line will act also as a support, and if we draw this line here, this line can also act as a resistance, okay. So this is basically the support and resistance in trending market, okay. The third type is basically the dynamic. So here's when the moving averages come in. So the dynamic support and resistances are basically the levels or the exponential moving averages, okay, and the exponential moving averages act as the dynamic support and resistance because they change along with the candles. So let me just put the exponential moving average indicator so that you can understand. So here is the exponential moving average indicator, and let me just change this to 38, okay, and let me just change the style and color, okay. So let me just change this to green. So these also act as a good support and good resistances. Like when the trend changes, this becomes this support converts into resistance. So this is basically a trend line resistance here, and this is a dynamic support here. You can see the price touching it and then bouncing back. Okay, so the exponential moving averages act as good supports or dynamic supports and resistances. All right, so now let me go ahead and show you how you can use exponential moving averages in order to predict the trend reversals or trend continuation, and how you can take some good profit or take some good trades there. Okay, so the first thing we need to do is we need to use a combination of exponential moving average indicators in order to predict how trend is going on. Okay, because with a single line it does give us an idea that if the market is trending up or down, but it doesn't give us a clear indication when the trend reversal is going to happen. So for that we need to use multiple indicators. So I'm gonna go here and type moving average and put this 3 times. Okay, and now I'm gonna change the values here, change this to blue. Okay, and I'm gonna also change the thickness, and let me just go ahead and do the same here. Let me change this to red and change the thickness. Okay, so basically here I have put the exponential moving average indicator, and now we need to decide what time frames we want to use these indicators. Okay, now there are different combinations that people use in order for exponential moving averages, and the ones that we mostly use are the Fibonacci levels, because Fibonacci levels are the natural levels and are mostly followed. They're found all in the universe. That's why we use Fibonacci levels as our time frames for our exponential moving averages. So let me just show you which Fibonacci levels we like to use in our technical analysis. So let me just draw this, and as you can see here that this is basically our 62 level or 62% almost, and this is almost 38%, and this is almost 23%. So this is what we are going to, these levels are what we are going to use in our exponential moving averages. We have made a separate video on how Fibonacci levels work and how they're calculated. So if you're unsure of Fibonacci, please go ahead and watch that video. Okay, so let me just go ahead and change this. This is 38, so let me just change, let me check the, so this is green, and I'm gonna change this to 23. Okay, and let me go ahead and change this to 38. Okay, and now let me go ahead and change this to 62. All right, so from here we can kind of see the patterns that whenever the crossover is happening, the trend gets reversed. Okay, and here as well, whenever the crossover happened, the trend got reversed. Now these most extreme or the 62 levels act as very strong trend support or resistances. Okay, and whenever these are crossed, that 52 moving average is crossed, exponential moving average is crossed, that means that there is very likelihood of trend to be reversed. So let me go ahead and zoom this a little bit. So here you can see that the market is going downward. Okay, and we can see that the market is going downward because the smaller time frames are below the larger time frame. So this is basically 23, this is 38, and this is 62 time frame moving average. So as long as the smaller time frame moving averages are below the larger time frame moving averages, that means that the market is trending in the downward direction. Okay, and when that crossover happens and the larger time frame moving averages go below the smaller time frame, that means that market is going to be bullish. So as long as the smaller time frames are below the larger time frame moving average, you can see the trend is bearish. But as soon as the crossover happened, as you can see here, that the 62 time frame moving average went to the bottom, and the 38 went in the middle, and the 23 went to the top. So this basically means that the trend has reversed, and we need to look for this crossover in order to validate that the trend is going to get reversed or going to get bullish. Okay, so let me just zoom this out a little bit and let's analyze another data point. Okay, so let me go ahead, and another thing that you should keep in mind is the moving averages are not useful at all during the ranging markets, like when the price is fluctuating in a range. Okay, it's going up down, or if it's not giving a very big changes or not trending. Okay, so then the moving averages are not useful. So we need to use the moving averages in a trending market, and that's when they're used as well. So here you can see as well that as long as the market, the small moving average is below the large time frame moving average, the market is trending downward. Okay, and here you can see that the candles did cross the 38 time frame moving average, but again the bearish trend continued. Okay, and here you can see this formation of a very big wick candle, and then again the bearish trend continued. But as soon as the crossover happened, the bearish trend got converted into bullish trend, because the smaller time frame moving average has come to the top and the larger time frame moving average has went to the bottom. Okay, and another indication to the trend reversal is basically the candlestick crossing the larger time frame or the 62 time frame moving average. So as you can see here, that when the candles broke through the 62 time frame moving average, the trend got reversed. Okay, and we can validate from the other pattern as well. Let me just go ahead and show you that you can see here as well that as soon as the market or the price went above the 62 time frame, the market started going bullish. Okay, and now this is basically acting as a dynamic support. Okay, now you might be wondering, why are we not using simple moving averages? So as I explained in the beginning, that simple moving averages are a bit slow to respond to the price changes in the market, and also they give equal weight to all the data points. That's why we use the exponential moving averages, because they give the most importance to the most recent data points, which are useful and in which we can see the price fluctuations more clearly and earlier than we see in the simple moving averages. Okay, so I hope you like this video. If you have any questions, please comment down below and I would love to answer them. And also please make sure to subscribe to our channel, and you can visit our website www.forexp.co in order to learn more about forex and price action. See you guys in the next video. Thank you.